What's going on, guys? Welcome to the 10th actual episode of my real estate investing Q&A show. I didn't actually think we were going to get there, but it's been going pretty well. I've enjoyed it. I think I've got a lot of good questions out of it, a lot of good answers, a lot of good stuff for you guys to listen to. Little quick update. We are almost ready to move into the new office. It is September 4th. We'll probably be in by the end of the week or early next week. I'm super pumped. If you do not follow me on Instagram, at chris.grenzig, definitely go over there. I'll be having tons of stories, posts, all that good stuff, so you can kind of check it out. Maybe I'll do some type of walkthrough once we get all the furniture and shit done, but been posting the whole way. So if you don't already, be sure to go follow me there. I just started, you can see it right there. I just started reading the book Traction. I've never been a big reader, especially on the nonfiction stuff. So what I'm doing is every day going to read 10 plus pages. Also going to post on Instagram every day. Just something I really want to enforce and do going forward, because I think a lot of good information, a lot of good ways for me to incorporate into the business and personal stuff. And it's just something I need to do more of. And it's going to be a way for me to kind of enforce that. So if you want to follow along, be sure to also follow me on Instagram. We are also about to wrap up the Columbus deal. We have all our investor equity lined up. We are sending out documents this week. Everybody's going to review, sign, fund, and then we're all set to close end of September. So super pumped about that. 360 units in Columbus, Ohio, $10.5 million, $4.5 million renovation. So super, super pumped about that. We also have another 2 or 3 deals in the pipeline, about another 240, 92, about another 580, 600 units. I would say 2 are pretty likely to happen. 1 is up in the air, but just 1 I really like. So could be a really, really interesting end to the year. We're also selling our 122 unit deal in Jacksonville right now. So we're under contract selling that. So end of the year, looks like it's going to be super busy, but super pumped, all good stuff. Really excited to talk more about that stuff, give you guys information as we go through it, especially after we close the deal, we get it under contract. I can talk about it way more, just because we actually own it. It's not under contract, so super excited for that, and definitely going to do some more stuff as we go through it. But that's basically it. With that being said, going to jump right into the question. So first question. If you are a multifamily syndicator, I'd love your feedback on this. What percentage of your deals require accredited investors only, as opposed to being open for sophisticated investors? Thanks, Steve. So an accredited investor, if you don't know, is an individual who has made $200,000 for the last 2 years or has a net worth of $1 million excluding their primary residence. If you're a husband and a wife, it's $300,000 for the last 2 years. And I believe it's still $1 million for your net worth. Either or, it doesn't have to be both. And the reason he's asking this question is because the government views people that make more money as basically having enough that they can lose it, and it's not that big of a deal. They don't want people creating investments or investment opportunities taking advantage of the small guys. So what they do is they have that accredited investor bucket, and it's a lot less stringent on the rules and regulations for the accredited investors versus the non-accredited investors. The sophisticated investor is someone that can kind of show they have a little bit of understanding, show that you have a relationship with them prior to just bringing an investment to them, but they are non-accredited. In our space for, I believe it's all alternative assets, but it may also be commercial real estate, there's 2 different types of filings. There's the 506B filing and the 506C filing. I'm also not an attorney, so make sure you talk to somebody way more knowledgeable than me about this. But the major difference, the high-level difference between the 2 is the 506C does not allow non-accredited investors or sophisticated investors, same thing, but it allows you to publicly solicit the investment opportunity. A 506B allows up to 35 non-accredited investors or sophisticated investors, but you cannot publicly solicit the investment opportunity. So for example, our Columbus deal right now, it's a 506B filing, so we can't publicly solicit. So I could not come on this deal, talk about returns, talk about the deal, and ask you to invest in the deal. I can talk about it and educate people, but there's a very fine line between publicly soliciting and not. I also can't run ads for it. I can't go on different podcasts and things of that nature, write blog posts about this opportunity is available, come invest. I cannot do that. For a 506c, I could do all of that. I could run ads. I can go on public forums. I can talk to people, any which way I can say we have it, but I cannot accept non-accredited investors no matter what. Mom and dad are non-accredited, doesn't matter, can't accept their money. So that's the big difference between the two. And what he asks is what percentage of deals do we do as the 506B filing and the 506C filing for us, because a lot of our investors are friends, family, close acquaintances, or, local, not local, but like, word of mouth, high net worth guys. Because we rely on, a lot of the word of mouth referrals, things like that. And a lot of our investors are repeat. They've probably invested in 50%, 75%, if not more of our deals. We don't need that 506c public solicitation option. So most of our deals, if not all of them, I know definitely one was 506c, but the others I think were all 506b, because we don't need to publicly solicit. They allow for non-accredited, sophisticated investors. Now, you do have to have proven points of contact before you allow them into the investment, or even before you talk about returns. I don't know the exact specifics or the numbers. I think it's 3 before you even talk returns, let alone let them or talk about investments or let them invest into a deal. But we personally do not do a lot of 506c filings because we don't need it. A lot of our investors are people we know that have a solid understanding, and we've spoken to a lot about what these investments entail, and that you could fully lose all your money. You could, make less than what we are saying. These deals are illiquid, so if you call me up and ask for your money back, I can't just give it to you. I have to try to sell your interest or put you in touch with someone that would buy you out. So most of our deals are the 506B. We do have non-accredited investors in our deals, and we don't really do the 506C because we have a lot of good investors that want to continue to invest, just haven't hit the accredited investor mark yet, as well as we don't need the ability today to do the public solicitation of current investment opportunities. So that's the reason why we don't do very many and why we stray towards the 506B. Next question. Would help if it would work. Hello, BP friends. My partner and I found an interesting property, and while we look at the income statement, the first thing we notice is the water sewer expenses is huge. It's a 30 unit, and they spent $22,000 each year on that. I think he means alone. We were doing some research and plan to install individual meters to pass their responsibility to tenants. Could someone share their experience on how this could be done? Any comments will be helpful. Thank you in advance. So, with multifamily properties, a common strategy on the utility side for mainly water, sewer, and trash is to pass the expense back to the tenants on something called a RUB system. Basically what it's saying is you charge a flat fee or their fair share of the cost back to the tenants because they're the ones using it. So that means the property is on a master meter, and that all the water sewer cost is going into that one meter, which is getting billed to the property. Same thing with the trash. There's one trash contract. It's not from an individual standpoint. However, two things to note. One is a lot of times you can only do up to a certain percent. So it might be only a 75% or an 80% recapture of that cost. The other part of that is a lot of states don't allow you to actually do that. So North Carolina, for example, doesn't allow you to actually come in and implement that strategy. If you want to do it, you actually have to individually meter all the units so that the direct cost that they use gets billed right to them and it's in their name, and that's how it works. So if you're looking to offset a utility expense like water sewer, which he's saying $22,000 a year for 30 units, that is incredibly high. There's probably another problem going on, whether it's probably a leak or something like that, or tenants are just running the water nonstop. If this was in that area, you would have to look at something else. So whether that's individually metering, if that's, I don't even know. I think that might be the only option, to be perfectly honest. Most of the areas we invest in do allow for the RUBS. So what we'll do is we'll look at the cost every year of the water, sewer, the trash, and we'll add it up and we'll find out what the recapture rate is. And then we'll go out and see what the market is also charging. Most times we see some sort of flat fee system. There are third-party companies that will actually address and figure out how much each unit is due, and the charges will fluctuate based on the usage every month, but we tend to just do a flat fee. It's easier, it doesn't cost us anything. It's based on the unit, so one bedroom might be $40, two bedroom might be $50, a three bedroom might be $60. Some places will actually do it based on the number of people living in the unit. Just adds more complexity. I don't recommend it. But we'll come in and we'll look at the two things. One, what is, let's say it's 80%. We'll look and say, what is 80% of the utility cost we can bill back for? And have they hit that mark? If not, we'll look to increase it. But conversely, we'll also look at what is the market charging in that flat rate fee. Because just because the property may be at 50% of bill back doesn't mean that you'll be able to get it, because maybe the market charges 30, 40, 50 for ones, twos, and threes, and you would have to charge 50, 60, 70. You're probably not going to get that unless all of a sudden you decide to incorporate the utilities into your rent charges, but then your rent would be lower. So it doesn't always necessarily make sense. Your combined cost is going to be more than somewhere else. So you have to look at a blend between the two. Just because you have the ability to take a property from, a lower percentage to a higher percentage doesn't mean it's necessarily practical. So as you're going in, make sure you talk to somebody local, whether it's the municipality, a broker, the owner. Find out how the utilities works and if you can charge tenants their fair share, and whether you can do it through a RUB system or something else. And then also look at what the market is doing and figure out if you're at your cap, if you can get up to the cap, or if it's not practical. So make sure you understand all parts of that. Last question. As someone who is knee-deep into the syndicator vetting process, I've come across many of the well-known syndicators that are now switching into the real estate fund model, grouping 2 to 10 deals into their own fund, at least as an option. Some still offer single deals with the fund option. I feel the fund model adds a layer of opaqueness to the evaluation of the deal, although it certainly diversifies things. For those experienced LPs out there who have invested in multiple syndications, what is your feeling on many of the well-known syndicators offering the fund model? Are you looking into them or steering clear? It certainly makes it more difficult to vet some of the deals, in that not all the asset acquisitions are even made at the time of the investment draw/call. After that, he just kind of talks about some things he's seen. But the question basically is, even though he's asking investors, I thought it was a good question to kind of pose on the opposite side of the coin as the syndicator sponsor running the deal. Do we look at the fund model or the one-off model, and have we considered changing? What are the pros and cons? So basically what he's saying is all of our deals right now are kind of in a one-off set. What that means is if I find a deal we create as an investment opportunity, I bring that specific deal to people. They're investing in that deal and that deal alone. The only time we've ever blended that was we bought a Jacksonville portfolio. We didn't allow people to only invest in one or two of the three. They had to invest in all three and equally across all three. But going into it, you knew what the three assets were. There was never an opportunity for us to go out and add something to it without your knowledge. So that's what it was. A fund oftentimes will be a structure that raises money to go out and buy certain types of deals. You won't know the deals beforehand. A lot of times the fund operators will list several deals that they're looking to acquire or might acquire in the near future, but it doesn't necessarily mean those are the deals they're going to go out and buy, or necessarily for the price they're going to buy them at. So they'll say, hey, we're going to target the Florida region, 100 to 300 units, 1980s to 1990s construction, and we're going to be targeting 15 net IRRs to the investors, and we're going to hold for 7 years. But it doesn't say we're going to buy these 3 properties. The pros on that for the investor side and kind of the fund side is the money can be invested today in that fund, and you can be invested today. The opposite side of that is if it's a one-off deal, I may not have a deal for you to invest in if you're looking to invest now. I can't just magically go out and get a deal. I'm not going to buy a deal I don't think I can raise money for. So if you have $200,000, $100,000, $1 million just sitting there and you want to invest today and I don't have something for you, you probably have to go look elsewhere, or you have to wait and sit on that money. Neither of them are great options. One, if you go invest with someone else, it doesn't help me. 2, if you want to invest now to start getting those benefits, I don't have something for you. You can't just magically wish something up unless you're going to be all the equity. Then we can go out, partner, buy whatever we want. But that's not the point of this. Some of the cons are for the investor side. Obviously, they don't know the specific deal they're investing in. They don't know how long it's going to take to buy that deal. For our side, some of the cons are if we have $5 million raised and it's been 3 months and we haven't found a deal, we're going to start to feel some of that time pressure to go out and buy a deal. And we may not buy a deal we would have bought otherwise if it was just a one-off. For example, last year, we probably went 5, 6, 7 months in 2018 without buying a single deal because we didn't find anything we liked. And then all of a sudden we found 3 properties at once in Jacksonville, Florida. There was actually 4, but we walked on one that we did like, and then we took them down. As this year has then continued, we've now found the second deal in Columbus, and now we've got 2 more deals, can't say where yet, that we're looking at as well with a potential third. So we could go long periods of time without buying a deal because we have no time pressure. We haven't raised money. We haven't said we're going to return certain returns to people based on them investing and giving us their money, even though there's not a deal today. So there is some of a negative of that. One of the ways to combat that is, as he mentioned, the draw or call setup. So basically, if you invest $200,000, I may only take 10% today, so 20 grand. And what will happen is you are committed for the full amount. I don't know how binding it is because we haven't gone down that path. But basically what you're saying is you're committing 200, but I only need 20 today, so I don't have to give you your full return on the full 200. I'm only giving it on the 20. And when I need your money because we found a deal or all the deals, I will draw or call another percentage of your 200,000 as we need it. So perhaps a month before we close, 2 months before we close on a deal, I'm asked for another 40%. So you're up to now 50% contributed, not committed. You know, you've committed 200. I've only asked you to contribute or required you to contribute 100,000 because we found the property. So even though you invest or commit $200,000 today, doesn't mean you're going to contribute that $200,000 today and start earning your returns and your other benefits for it today because there is that draw schedule. So that's a way to kind of blend the two. It allows you to commit that money to an investment, and oftentimes there's an expected time frame for that money to be fully contributed and invested. So you often see a lot of times funds will do that type of structure to kind of split the difference between the two. But there are funds that will go out there, raise the full amount, and then go place it. So you hope they have really good deal flow and they have deals up front. That's kind of the difference between the two. For us personally, just to kind of give you my opinion, we've only done one-off deals to date. Like I said, the only kind of blend we've done is the Jacksonville portfolio, but the deals were known beforehand. There were 3 deals where they were buying It was just you couldn't split your money how you wanted, or you couldn't pick and choose of the three. However, we have somewhat started considering going to a fund model recently, because it does allow us to offer a little bit more aggressively if we know we have the money up front. So that could be hard money, quicker closing time frame, shorter due diligence period, no financing contingency. That's kind of standard anyway, but it just allows us to be more aggressive because we know, hey, we've already got the $8 million in equity committed. So if we need that money tomorrow, we can get it within 48, 72, whatever's beyond that, 80 hours, whatever it is, because everybody's committed. We just haven't drawn down the money. Or if we've already drawn down the money, we would probably do the draw schedule. But if we've already drawn it, it's sitting in the bank ready to be deployed. So we can move quicker than groups that are doing a one-off. Also, it does just make it a little bit cleaner from the standpoint of the organizational side. When we have 6, 7, 8, 9, 10 deals, every single deal has a slightly different structure involved. For example, investor A may own 5% of this deal, but he owns 10% of another deal. And he may be invested in this deal with this property and this deal with his IRA. So when you have a fund, people are invested in the fund across 2, 5, 10 deals as the same percentage ownership with the same entity, or that entity owns the same amount. They could obviously be involved in multiple entities, multiple IRAs, multiple LLCs, multiple trusts, et cetera, but it does allow for a little bit cleaner that it's every year for those 5 properties, the tax returns, the structure, the equity is all 1, 2, 3 laid out exactly the same. So it does make it a little bit easier from the paperwork organizational side. It's not this deal's this way and this deal's that way, and this guy's in this deal but he's not in this deal. We talk all the time, and we sometimes forget exactly what deals they're in because they're in 7 out of the 10, and you've got to remember, well, this guy's not in this one, but he's in the other 3, and investor B is in 2, 3, and 4, where the other guy's in 1, 3, and 4. So it does just add a little bit of complexity and having to remember to look up who's in what and what percentage at what rate and things of that nature. So being in a fund does do that as well. It also spreads your risk out evenly across all the properties. So if you own 5% of the fund, you are 5% of the equity in every single deal. It might be $20,000 in one deal and $50,000 in another, but it's 5% of the equity in that deal. So it does also diversify risk evenly across all the deals as well. From the investor standpoint, that makes sense. So if you were an investor and you wanted to own 5% of every one of our deals, you could obviously back into the math and do it that way, but this is just an easier way to do it, that you own X% of all the deals in the fund. So that's kind of my thoughts very quickly on the fund versus the one-off. I think we'll continue to stick with the one-off for the near future. Maybe we'll test it out with the small fund. We've also, we've already talked about doing a fund for the mobile home stuff. We've talked about actually doing an equity fund where we would invest in other operators' deals with some of our investors, where basically we would open up equity fund Toro 1 LLC, go invest in 3, 5, 10 deals, spread the money out across, and just place money for people because we're experienced. We can look at deals and know whether we think this is a good deal, bad deal. Might just be a deal we didn't know, might be in an area we're not 100% in, things of that nature. We've also talked about, instead of as a straight equity partner, do it as a preferred equity piece, which is something I can talk about another time, but it's basically less upside but more conservative, but just something we've spoken about. But that's it for this week. If you do enjoy these videos, whether this is your first one or the 10th one you've watched, it would mean the world to me if you would subscribe, like this video, leave a comment. If you have a question you would like to see answered in the future, please drop it in the comments below. DM me on Instagram, email me, chris@tororep.com. I like and prefer to use actual questions. Once in a while, I've used Biggerpocket. Biggerpockets. I've used it for the last 2. I would like to get back to using some more of the Instagram stuff or email questions. I need to get out and ask people and prompt people more. But if you have a question, please drop it below. Get in touch with me. Let me know what they are. And that's it. That's my show. Thanks for watching.